Hello, everyone, and thank you for attending this week's lunchtime webinar from Hendricks Wealth Estate Management. I'm Jim Madl, financial advisor with our firm. I'm joined here today by Dan Leitner and Jim Hendricks. Our topic for today, I'm going to focus on what to do if and when you receive an inheritance, and more importantly, how to make it last. Receiving an inheritance is one of the most emotionally complex financial events a person can experience. It isn't just a financial transaction. It's a profound moment that most often happens during a time of grief and sorrow. It's about legacy, family, and a new sense of responsibility. Our goal today is to give you a clear, professional, and actionable roadmap. We'll cut through the confusion, talk about the tax traps to avoid, and discuss specific benefits to maximize. By the end, I hope you'll have a confident framework for making smart financial decisions for your future should you unfortunately receive an inheritance of any size. There is a Q&A button down at the bottom of your screen for you to add any questions, and we'll look to answer any of those following the presentation. So when you receive an inheritance, you're standing at a crossroad. On one side, there's the emotional weight of grief. On the other, there's the financial weight of gratitude, confusion, and a sudden, overwhelming sense of responsibility. Many beneficiaries ask themselves, what do I do now? Am I going to mess this up? And those are legitimate questions. This is a time when some of the biggest mistakes are made, not out of greed, but out of haste and just a general lack of knowledge. The best decisions are made from a place of clarity and deliberate planning. So today we're going to try to provide that clarity for you. Our agenda is going to be simple but crucial. First, we're going to talk about what to do in the first 90 days, and that's what to do, but more importantly, what not to do. Second, we'll demystify the IRA tax bomb, specifically the 10-year rule that was introduced in 2020. And third, we're going to look at the brokerage bonus, which houses a powerful tax benefit for us. And then finally, we'll put it all together in a strategy for life to make an inheritance truly last. One of the most important pieces of advice for the first 90 days is to do almost nothing financially. Your financial plan should not be a reaction to grief or, in some cases, greed. As the slide says, please do not buy the boat. Do not immediately pay off your 3 to 5% mortgage when your cash could be earning more. And if the inheritance is significant enough, don't quit your job. Your biggest task, not tax, we'll talk about that later. Your biggest task in the first 90 days is to get yourself organized. You're going to do this in 3 steps. 1, you're going to secure the cash. Any immediate cash you receive, whether it's from a checking account or life insurance, should go into a new, separate high-yield savings account. Do not commingle it with your household money. This creates a firewall and prevents impulse spending. Also, if you're married, you would be wise not to mix the inherited assets with your current joint cash. An inheritance is not considered a marital asset until it is mixed with that marital cash. Number 2, identify all your assets. Here you need to become a little bit of a detective. You want to gather statements. We need to know exactly what we're dealing with. Is it a traditional IRA, a Roth IRA, a brokerage account? Is it proceeds from sale of a home or other real estate? The rules, which we're going to cover in a little bit here, are wildly different for each, and making any missteps can cost you valuable dollars. And third, you're going to want to assemble your pro team. This is not a do-it-yourself project. The stakes are too high. You're going to want a 3-stool approach of a team of professionals who will talk to each other and help you through this process. 1 is a financial advisor to create the strategy. 2, a CPA to handle the tax implications. And 3, an estate attorney to settle the legal side of things for you. Trying to save a few dollars here can cost you much more down the road. Okay, now let's get into the specifics here. The most complex of any inheritance is always the retirement accounts, IRAs, 401ks, and the like. The rules are entirely dependent on your relationship to the person that passed. Path one is the spousal beneficiary. If you are the spouse, you have a great deal of flexibility here. You do have several options, but the most powerful and common is the spousal rollover. You can take that inherited IRA or 401k and roll it directly into your own IRA. The money is now treated as if it were always yours. Your required minimum distributions, or RMDs, will be based on your age and not your late spouse's. This can be a huge advantage from a tax and distribution standpoint. Then there's path two, which is more common. It's the non-spousal beneficiary. This is pretty much for everyone else: a child, a grandchild, a sibling, a partner, etc. And the rules here are quite rigid. You cannot roll this money into your own IRA because you do not receive the spousal benefit. Instead, you must open a new, specially titled Inherited IRA. You may also hear it called a beneficiary IRA. This is where you'll become subject to a new and strict set of rules thanks to the Secure Act that was passed in 2020. Let's take a look at one of the most significant changes, the rules for non-spouse beneficiaries. If you're a non-spousal beneficiary, this is the most important and potential problematic rule you'll need to know: the 10-year rule. Prior to the Secure Act being implemented, inherited IRAs were subject to something called the stretch rule. And the stretch rule allowed non-spouse beneficiaries to stretch their withdrawals over their entire lifetime, allowing you to spread distributions from the inherited IRA over the course of many years. The Secure Act replaced it with something called the 10-year rule, which is a potential tax time bomb if you don't plan wisely. The 10-year rule states that you must withdraw the entire balance of that inherited IRA by December 31st of the 10th year following the year the original owner, passed away. The entire account must be empty by that date. So why do I call it a tax bomb? If that IRA is a traditional IRA, which is the most common, every dollar you withdraw is taxed as ordinary income. Any withdrawals are added on top of your salary, your spouse's salary, and any other household income you may have. And oftentimes, this can bump you into a higher tax bracket. The money must be withdrawn from the inherited IRA. It does not have to be spent, but it must be cleared from the account and taxes must be paid. So imagine inheriting a $500,000 IRA and you don't know the rules. So you just let it sit. And then in year 10, you have an accountant that says, oops, you have to take all this out in this 1 year. So you withdraw $500,000 in year 10. That one-time withdrawal could launch you from the 22% tax bracket to the 37% tax bracket, in essence, causing you to lose an extra $100,000 or more to taxes needlessly. And kaboom, you've set off the tax time bomb. This is the single biggest and most costly mistake a lot of beneficiaries of IRAs make, purely because they're unaware of the new tax rules. So how do we defuse this bomb? We don't wait. We don't take a lump sum. We plan. We smooth the tax impact over the 10-year window we're given by the IRS. If you look at that bar graph, and it's a little light at the top, but if you look at the bar graph, that red bar is the wait and see disaster we discussed earlier. You take it all in year 10 and you pay the highest possible tax rate, 37%. The green bar is the planning strategy. By working with a financial advisor and CPA, they can look at your income and build a plan that determines a distribution strategy that allows for the greatest tax efficiency. Based on the specific distribution plan that's implemented, let's say you can strategically withdraw $50,000 every year for 10 years, keeping you in a lower tax bracket, your total tax savings can be quite significant. Your distributions will likely vary every year as well, because it's an active year-by-year strategy. Maybe you're planning to take a sabbatical in 3 years. So that's going to be a lower income year. That's going to be a perfect time to take a larger distribution from the inherited IRA because your income will be lower at that point. Build the plan and then monitor your specific situation each year to make necessary adjustments to keep more of your inheritance in your hands and give less to the IRS. And while traditional IRAs are more common, what do you do with an inherited Roth IRA? This is a key point here. The 10-year rule still applies. You still are required to empty a Roth IRA, inherited Roth IRA, within the 10-year window. But the magical difference, every single withdrawal is 100% tax-free. You still need a plan, but it's a plan for when to take the money out of this Roth IRA, not how to avoid taxes. By keeping the money invested inside the inherited IRA for longer, you're going to continue to get tax-free growth for that entire 10-year window. However, if you don't empty the inherited Roth IRA in year 10, the remaining balance is subject to a 50% penalty by the of the IRA, and that's a really big tax bomb. So we want to build a plan to move any inherited Roth assets out of the inherited account and into an individual investment account in year 10 to keep it invested while avoiding unnecessary penalties. All right, we've talked about the tax traps. Now let's talk about the big tax bonus, and that comes with inherited brokerage accounts. These are regular non-retirement investment accounts, similar to a savings account you might have at a bank. These brokerage accounts are treated completely different. And believe it or not, the tax rules are 100% in our favor. It's because of one big, beautiful concept called a step-up in basis. So let's walk through a step-up in basis concept. Let's say your mom was a brilliant investor. In 1990, she bought $10,000 of Apple stock. So that $10,000 she bought is her cost basis. Today, let's say it's worth $500,000. That $490,000 growth is a taxable gain. If she were to sell that stock today, she would owe capital gains tax on that entire $490,000. But she didn't. She passed away, and you were fortunate enough to inherit that money. The IRS, in this one instance, is very generous. They will step up your cost basis from her original $10,000 to the fair market value on the day she passed. So your new cost basis is now $500,000. What does this mean? It means you get to sell that stock the very next day for $500,000, and your taxable gain on that is zero. That $490,000 gain that she had, poof, magically erased, 100% tax-free. This is arguably the single most powerful tax break in all of estate planning. So why is the step-up in basis so powerful? Because it gives you a get-out-of-jail-free card for bad, old, or over-concentrated portfolios that you may have inherited. What's the trap here? Emotional attachment. We hear it all the time. You know, I can't sell mom's favorite stock, or this name your favorite stock has been in the family for 60 years. Let me be clear, as a fiduciary advisor, I can safely say a portfolio that was appropriate for an 80-year-old is not very likely appropriate for a 50-year-old. That emotional attachment can be incredibly costly. The action is simple. You need to reallocate. The step-up in basis that we're talking about gives you a golden opportunity. We can sell that portfolio of, let's say, 10 random stocks, where 50% might be tied up in one company, completely tax-free. We can then use that cash to build a modern, globally diversified portfolio that's designed for your goals, your timeline, and your risk tolerance. It's a clean reset. Same would be true for those inherited IRAs, both traditional and Roth. Make sure they are reinvested to match your specific situation. An 80-year-old may have a large concentration of bond funds or other fixed income investments in their portfolio, as that was an appropriate investment strategy for them. But the odds are it's not suitable for you. A financial advisor like the three of us on the screen here and all of us at Hendricks Wealth Estate Management can help find the appropriate allocation for your specific situation, your goals, and get you reinvested in accordance with your plan. All right, we've navigated the tax rules. We've reset the portfolio to match your needs. And now you have this pool of inherited money. How do you use it without blowing it like many people do? Well, you give every single dollar a job. Consider using something like the 3-bucket strategy. It's simple and it works. Bucket number 1 is security. And this one's non-negotiable. This is the money for the next 0 to 2 years. If applicable to your situation, the very first thing you do is pay off or pay down all your high interest debt. Credit card bills, personal loans, etc. Get rid of them. And when they're paid off, throw away the shovel, those credit cards that put you in debt in the first place. The second thing you do with bucket number 1 is build a 6 to 12 month emergency fund in cash. This is your shield. It protects you and it protects the rest of the inheritance from being frittered away. Bucket number 2 is for your midterm goals. This is for 3 to 5 year money. This money is for specific goals. Like, I want to put $100,000 down payment on a house in 5 years, or I want to fund my kids' 529 college plans, or I want to start a business. We invest this money, but possibly a little more conservatively because the timeline is shorter. And bucket number 3 is your long-term legacy. This is the 5+ year money. This is the money you do not touch. This money is invested for long-term growth. This isn't your parents' or grandparents' retirement fund anymore. It's your retirement fund. It's the seed for your legacy. You let this grow and compound, honoring the gift of inheritance by multiplying it, not only to help your retirement, but to also pass the legacy down to the next generation. We've covered a lot today, and if you remember just 5 things, let it be these. 1, pause. Give yourself 90 days. Don't make any rash decisions. Assemble your pro team, your financial advisor, CPA, your attorney. Number 2, IRAs can be a tax bomb. Know the 10-year rule. You must have a withdrawal plan to smooth that tax bill and avoid penalties. Number 3, brokerage accounts are your tax break. Use that step-up in basis as the gift it is. Sell, diversify, reallocate the account holdings tax-free to suit your plan. 4, have a strategy. Use that 3-bucket system to give every dollar a purpose: security, goals, and legacy. And lastly, and most important, remember to honor that legacy. An inheritance is often the result of a lifetime of hard work, savings, and sacrifice from someone you loved and someone that loved you and cared about you. The best way to honor that legacy is to be a good steward of that gift. Use it to create financial security for your family and build a foundation for your future generations. Remember, plan wisely. All right, so that wraps up the making your inheritance last. I want to thank you for your time. I know this is a complex topic, and a lot's based on everyone's own personal situation. I'm happy to answer any questions that might come in now. If you have anything that's maybe a little more personal, our contact information is on the screen, and please feel free to reach out. You can schedule a private complimentary consultation to discuss your specific situation in more detail. So now we'll look and see if there's any questions coming in here. And while we wait to see if there's any questions, we host these webinars every Wednesday at 11:30 Central Time. If you're interested in seeing our upcoming topics, I invite you to visit our website and click on the events tab. Our website is on the screen there. Well, it's no longer on the screen there, but it's www.hendrickswealth.com. And again, up at the top, there's a little events tab. Also, if there's a webinar that you may have missed, I invite you to go on to our website, and you can go to our resource center, and we do have an archive of all of our prior webinars. So if there's a topic of interest that you may have missed, feel free to check that out. All right, I don't see any questions coming in here. So I want to thank you all for your time, and feel free to reach out if you have any questions down the road. Thank you all very much.